It's official now, the Indian economy is slowing. Hello and welcome to this special edition of Indianomics. I'm Lata Venkatesh. The Central Statistical Organization has said that India's GDP growth will be only 7% this year. Just a month ago, it had given us a number of 7.2%. 7% this year is lower than the 7.2% that the economy grew last year. Finally, the CSO told us that in the third quarter, that is the October, November, December quarter of 2018, GDP has come down to 6.6%. In the first two quarters, we saw 8% first quarter and 7% second quarter. By reduction, the fourth quarter GDP should come in as low as 6.3%. Okay, now let's come to Q3 GDP itself. Agriculture has been the biggest drag, going down to 2.7% versus 4.2% in Q2 and 4.6% in the year ago third quarter. That probably explains all the farm distress. Next, manufacturing at 6.7% is also slower than the 6.9% in Q2 and 8.6% year ago. Construction, yes, that's the positive. It has picked up to 9.6% compared to 8.5% in Q2 and 8% year ago. But let's see if we can maintain the momentum, especially because the government is not spending. Finally, trade, hotels and transport, which is a large category in services, has slowed to 6.9% from 8.3% year ago. It was at 6.9% even in the first half. From the expenditure side, the bright performance has come from private consumption expenditure and from capital expenditure in the private sector. Private consumption has grown at 8.3%, very good, while capital formation did even better, growing at 10.6%. Exports also staging a strong comeback with 14.6%. What was the laggard? Government expenditure, lagging at 6.5%, could do even worse in the fourth quarter since there's hardly any money left with the government to do capital expenditure. With this, let me go to my guests. At the moment, I have with me Dr. Pranab Sen, economist, former chairman of the Statistics Commission and former chief statistician himself of the country. Also joining me is A. Prasanna, the chief economist at ICICI Securities primary dealer. Gentlemen, welcome. I'll begin with Prasanna first because he was the only one of all the economists who polled who said that he expects the GDP growth to come in as low as 6.6 and GVA at 6.4. Prasanna, what are your key takeaways? Slowdown confirmed and Q4 is going to be even slower at some 6.3?
That's right. Based on the calculations, we now estimate that what the CSO is saying is the Q4 GVA will be 6.4% and GDP will be 6.5%. So again, if you look at the Q4 numbers of last year, again, which are all imputed because we don't have all the quarterly numbers available, so the base is relatively strong in some of the services sectors. Also, we have to understand that I think the government balances are under a lot of pressure in terms of trying to maintain the fiscal deficit target. So it's possible that the government was also forced to cut some spending, say in March, which would also kind of impart downside pressure on public administration and defense component of the services sector. So there can be some downside risk even to these imputed values. But by and large, broadly for the full year, I think 7% on the GDP growth is something which we are sticking to at this point of time.
Okay, you're sticking to 7% GDP. Dr. Sen, let me not ask you any leading question. What are your key takeaways from today's numbers?
Well, a couple of things. The first, of course, is that the slowdown in agriculture, which is quite significant, is something that we should have expected. The agriculture numbers were starting to look extremely bloated. And this is much more in line with what happens in agriculture. So I think it's a good thing, nothing to get worked up about. Now, I think you have to understand the key difference between the first advance and the second advance estimates is that you get the SEBI advance filings for the third quarter as well. So that's the additional information that is being used. And what these numbers are suggesting is that that's what's turned weaker. Now, going forward into the fourth quarter, we have to remember we are now in an election year. And the quarter before elections usually sees a spurt in demand, which is caused by nothing other than the elections itself. right? Now, the way one does these advance estimates is you assume that patterns that existed in the past will continue for the present as well. Now, in an election year, that won't work. So I would tend to think that the fourth quarter may give you an upside surprise.
Okay, well, let me toss the same question to Prasanna. What's your estimate of the fourth quarter itself? Do you think we are going to see continued weakness because of what you observe in the debt market? Or would you go with Dr. Sen that maybe political parties can spend and we could get a slightly better fourth quarter?
Well, that's always possible, but probably I guess the trigger for that would be when actually the elections dates and whatever the entire schedule gets announced. Maybe if that gets delayed till the middle of March, then maybe probably a lot of that bounce could come only in April, and so maybe it will not happen in the fourth quarter. But as far as the conditions in the bond market or the liquidity conditions are concerned, I would say that actually the liquidity conditions at least are definitely much better. I mean, seasonally, of course, liquidity is tight this quarter, but compared to where we were, say, last year, September, October, from that, I think the way RBI has been managing the situation, things have improved. Now, in terms of obviously ability of companies to raise money, I guess things have turned a bit tight. But that is, I mean, and that is something which I guess it started way back in August. So obviously maybe there's not a significant improvement in that. But still, if you again go back to October, probably the bond market came to a standstill. Compared to that, I would say that things have definitely improved.
Oh, okay. That's good to hear. Actually, Dr. Sen, I also wanted to ask you about capital formation. If you looked at gross fixed capital formation only for the third quarter, it's come in at 10.6. That's a little slower than the 12.2 that last year's number indicate. But I guess a 9-month number would be better. And if you looked at the 9-month number, it is 10.8% versus 8.4. So clearly capital formation has picked up. Do you think it can continue? Because these first 2 months, Jan and Feb, we have seen tight liquidity conditions and also poor consumption numbers from the previous quarter. So do you think that capital formation can continue unhindered? Government is not going to do much or has not been doing much because they're using their cash for farm income.
Well, you know, the recent release by RBI suggests that credit demand is down in February. Now, if that is the case, whether that's an aberration or that's showing a turning trend is really the question. But the real issue is that, look, there is liquidity, but you know, we've been talking about this huge increase that's taken place in currency in circulation.
Yes.
And everybody's been wondering what on earth has been happening. I mean, you're back to the pre-demonetization levels and above. So there was a huge question mark, and I think much of it has to do with this whole election game. So looking at the credit market as if it were in some kind of a stable state, I think would be wrong.
Oh.
There are other forces that are at play out there, but weakening of credit growth is of concern because there's no obvious liquidity constraint. So this seems to be a demand side problem.
A final question to both of you about FY20 itself. If you looked at the CSO's numbers, it was 8.2 FY17, 7.2 FY18, and now 7% FY19. Your best guess, Prasanna, for FY20, would we do better than 7? Just about same?
Yeah, so we do expect an improvement in FY20. In fact, our estimate at this point of time is 7.3%. Obviously, a couple of reasons. One is that I think oil prices have come off. So obviously, this year in the first half, actually, the economy was facing quite high oil prices. And compared to that, we got some relief in the second half. Now that relief will be there available for the full year next year. Also, there is going to be some sort of fiscal easing. I mean, even the interim budget suggests that, and it's possible in the regular budget, we get a further fiscal expansion, and the states might also follow suit. On the monetary side, I'm a bit cautious. I mean, the RBI has been cutting rates, but the transmission is not happening. So probably that is something where I think we still have to wait and watch. But at least on the liquidity conditions, I do think the RBI has definitely turned a page, and I would expect into next year also they will be quite proactive in providing liquidity. So putting this all together, we are cautiously optimistic. Of course, the wild card is always how the global outlook shapes up. There does seem to be a significant manufacturing slowdown happening globally, and particularly concentrated in Eurozone and China. So if those conditions don't improve, then definitely that can have a negative effect on India.
Okay. Well, actually, since you brought up that point, the Reserve Bank is still working with some 7.4%, and they are still speaking of, output gap not being very pronounced, at least some of the MPC members. So now with the CSO itself cutting it down to 7% and, Q3 GDP, shouldn't you expect more loosening from the Reserve Bank? At least one cut in April.
Yeah, so we do expect one cut in April. In fact, that was something we penciled in even before this GDP data, just
so now
purely
two cuts?
based on the inflation trajectory. I mean, I would still think one cut at this point of time. And like I mentioned, since the regular budget does promise or looks to promise more fiscal easing, I would think the MPC would probably tactically cut in April and then wait for the budget and then decide on its next course of action.
Okay. Dr. Sen, your forecast for FY20, and more importantly, where does this leave the Reserve Bank now that we have lower than their expectations in terms of CSO numbers?
Well, as far as forecast is concerned, it's a little difficult to say. I think what we will get for the current year would be about 7%. Now, as far as next year is concerned, I think there are two contradictory influences that are working. The first influence is that, post-election years always tend to show lower growth than the pre-election year. That's been the pattern. So one should then expect sub-7 next year. But on the other hand, if the PM Kisan works and it is followed through next year, it may just provide the requisite liquidity into the agri-markets to help an agricultural revival, which then in turn leads to a demand revival. So you have these two things working, but I would suggest it would probably be around 7% next year as well.
Thank you, gentlemen, for your analysis. We have to take a break. We are coming back with two prominent women economists. I'm going to be joined by Sonal Verma of Nomura and Pranjal Bhandari of HSBC in just a minute. Don't go anywhere. Welcome back to Indianomics and to our analysis of the third quarter and the FY19 GDP numbers. I'm now joined by Sonal Verma, the Chief Economist of Nomura India, and Pranjal Bhandari of HSBC. Ladies, thank you very much for joining me. Sonal, should we be regretting that the GDP for the third quarter has come in as low as 6.6 and could come in as low as 6.4 or 6.3 for the fourth quarter? Or do you think things are troughing out?
Hi, Lata. It's in line with our expectation. I think what we are clearly seeing is a slowdown, but beneath the slowdown, there are sectoral divergences. So clearly investment side has held up while the moderation is more because of government consumption and to an extent private consumption. But sort of looking ahead, I don't think the macro policy changes we have seen, the impact of that is going to be visible that fast. Of course, there are transmission lags, and therefore we do think that the final quarter, the fourth quarter growth number, as well as the first quarter FY20 number, will be in the 6 to 6.5% range. So our expectation is that at least for the next 6 months, one should expect a further moderation in the economic cycle before things start looking better.
Okay. Pranjal, before I ask you all, both of you all, what this means for policy itself, what are your key takeaways from the wealth of GDP numbers?
Well, look, yes, this is a slowing number. After a year, the GDP growth has fallen to under 7%, and the fourth quarter, as per CSO's numbers, will be even weaker. Jan to March will be 6.3% growth, as you highlighted. But I think I don't think we should look at the story only from that lens. I think there's another lens which is very important, that there are some positives out there too. For instance, in a seasonally adjusted sequential basis, quarter on quarter, growth actually improved in this quarter. That's one. Second, the core GVA number, which is basically GVA minus agriculture and minus public services, which we use as a rough proxy for private sector, actually rose in this quarter to 7.1% versus 6.9% in the last quarter. And we actually also see from other sectors, for example, PMI services, PMI manufacturing, that things are not that bad in the private sector. Things are actually improving. So I think these things should be kept at the back of our minds. Also, if you look at some of the details of GVA, for every bad news, there's something which looked better than before. So for instance, agri was very weak, but on the other hand, construction was very strong, and we attribute it to roads, housing, and the building up of toilets in the country. Even on the expenditure side, consumption was weak on the private and government side, but on the other hand, investment was strong. So, we shouldn't completely get carried away by a negative narrative is what I'm trying to say.
Fair point. But, this seems to somewhat fly in the face of anecdotal evidence. Sonal, how much positive should we take from the consumption of what 8.3% private final consumption and even this capex number? Look at the auto sales numbers that we got for November and December. Look at the broken state of the debt markets, the falling credit numbers. So are these to be relied on, or should we look at this anecdotal data?
I mean, I think, as has always been the case, we should look at this and supplement this with the anecdotal numbers. I agree with Pranjul that the quarter-on-quarter number is better. However, if we compare this to actually the strength we had seen in the Jan to June 2018 period, the quarter-on-quarter seasonally adjusted number was actually running at 2% QOQ. That's an 8% annualized growth, whereas in the July to December period, the number has been about 1.2 to 1.4%, which is on an annualized basis, actually, even in the latest reading, in the 5.5 to 6% range. So I think the overall momentum has clearly moderated. The second point I would make is, how sustainable is the consumption demand. Of course, it's slightly slower as per the GDP numbers, but like you said, Lata, the high-frequency indicators are suggesting that the slowdown is much worse. But more importantly, I think how sustainable is the investment strength. And there we do have our doubts that this is going to sustain, because what has changed is clearly the export cycle, which is now globally turning down. And historically, the export downturns have been linked to a slowdown in the manufacturing cycle and in the investment cycle as well. And not to forget that, for at least, the first half of 2019, there is political uncertainty, which is going to mean some delay in investment projects that get announced. And I think financial conditions are still tight. So our view is, yes, investments have been strong, but the sustainability of that is in doubt.
So would you root for 2 more rate cuts, Sonal?
Well, I think, we are expecting another cut in April, and we see a probability of 1 more after that. I think 2 things here. One is the RBI's growth projection, which is 7.2 FY19 going to 7.4 FY20. FY20 numbers we do think are too optimistic. Our own expectation is that the number is actually going to moderate from 7 to around 6.8. So directionally itself, we see numbers coming down, not going higher. And second, the average inflation for FY20 and even the year ahead projection is still looking sub 4%. So 1 more and potentially a probability of another after that.
Okay, but Pranjul, is there any chance of 50 bips in April at all? What are you penciling in after looking at the growth numbers?
Well, Right. Look, as I said before, don't want to get too carried away. Right now, we do have a 25 bips rate cut in April, and after that, a hold. And I will sort of stick to that for now. And I'll tell you why I think so. You know, a lot of the growth slowdown that we are talking about right now, I think they are a result of yesterday's problems. The fact that oil was at $85 a barrel in 2018, the fact that NBFC problem was fresh in the month of September and October in 2018, both of these have sort of softened now, at least a little bit compared to then. Also, the fiscal policy expansion that we are seeing, monetary easing, 25 bips in February, 25 more in April, all of that could support growth in the second half of 2019. I think the short-run concerns on growth are overstated. But on the other hand, I think the long-term concerns are not being acknowledged properly. India's potential growth is stuck at 7%, yes, and nobody is talking about how to revive the investment cycle meaningfully to take it closer to 8%. I think that's where the debate should move at this point, yeah, rather than, one extra 25 bips or or 25 versus 50.
Now for the larger question that Pranjal is raising, Sonal, and I want to ask you as well about that. Government contribution to capex is already dwindling. Government final expenditure has not done very well in the third quarter, is expected to do even more poorly in the fourth quarter. And now we are seeing large farm income transfers or loan waivers when it comes to state governments. I mean, capex has gone for a toss as far as the government is concerned. Should this be a longer-term worry, as we venture into FY20?
I think that is clearly, one of the biggest concerns we've had, for the last 5-6 years in terms of when the investment cycle will pick up. Now, on the government side, like you said, the composition of spending is clearly moving towards consumption rather than capex. So whatever capex expenditure in any case has been off balance sheet, driven more by public sector companies, and that perhaps will continue. But the on balance sheet spending by both the center and the state government does look like it's going to come down. So overall, public sector capex is unlikely to meaningfully improve. So that brings us to the private capex side. I think, the question to ask is, do we need capex, and do companies have the ability to do capex? The ability aspect becomes a lot more important given the balance sheet deleveraging that's still going on for the capex heavy sectors like infrastructure, construction, etc., telecom. And therefore, for them, growth is not necessarily a priority. It's more balance sheet cleanup. And I think that process is set in motion because of the bankruptcy code, etc., but it's still a work in progress. And if some of these projects and companies are available via the IBC procedure, I think the question to ask is, why won't companies do brownfield capex rather than put up new plants if you can just buy something? So I think in the next year or so, particularly given the domestic political uncertainty, given the need for balance sheet deleveraging, and given the global capex cycle, which is also slowing down, I think it's quite unlikely that over the next 12 months we see a capex revival. But if we do set the balance sheets in a proper foundation, then at least we create the space for capex to pick up. If not in 12 months, then at least after that.
All right, ladies, let's wait and see how things pan out. It's quite clear that the government is not lifting the capex mantle, but it's taken over the consumer mantle. Let's see if private sector rises to the occasion. Thank you very much, Pranjal and Sonal, for giving us your understanding and analysis of the GDP numbers. That's it on this edition of Indonomics. Thanks for watching.